So today we are going to discuss the financial management chapter 2, and it is basically based on types of financing. And you can say it's one of the very important topics of credit management, but financial management is a bit different than credit management as we discussed yesterday. It is in the point of view of the customer, whereas credit management is always in the point of view of the bank or the credit manager itself. And today's session is going to be very crucial for anyone in banking industry, right? Whether you are preparing for BOI credit, any PNB credit, or risk, or journalist officer interviews, because we are going to cover almost all types of financing, and this is crucial in terms of written exam, in terms of your interviews. And we have 101 slides tonight. I will try my best to cover all of them in one go, so that unnecessarily we will not stretch the session into two parts. Okay, looking into time constraints. So sources of financing. There are few sources of financing which we need to discuss tonight: equity share capital, preference share capital, retained earnings, debentures or bonds, loans from financial institutions including bank, and other type of financing. Okay, so these are the various types of finance, source of financing, or taking a loan, financing in the point of view of a customer, so, or in the point of view of a business. So business can arrange fund, or business can arrange money through these 6 options: equity share capital, preference share capital, retained earnings, debenture bonds, loans from financial institutions, and others. So financial needs of a business. What kind of financial needs? Business may need funds for longer period of time, medium period of for a medium period, for short-term financing or short-term needs. Clear? And very quick period of time also they need fund, and that will be called as working capital needs of a bank, of a institution, not a bank. Working capital needs of a company. Clear? Long term stretches beyond 10 years, or sometimes it is 5 to 10 years. Medium term up to 5 years. Short term up to 1 year. So basic principles of funding various needs. The basic principles for meeting the short-term financial needs of a concern is that such needs should be made from short-term sources. If you have short-term needs, then arrange funds from short-term sources. If you have medium-term needs, then arrange funds from medium-term sources. If you need funds for longer period of time, arrange funds from longer sources. That will make your business remain stable. Clear? Is it clear? Yes. Is it clear up to now? What will be the problem if you arrange short-term funds for your longer-term need? Your asset liability mismatch will happen, because you need fund for 10 years. But you have arranged a personal loan that is repayable up to 1 year, right? So you have deployed this cash for 10 years in your business, and you will get benefit, or you will get refund from your customers through sales in upcoming 10 years. So you will not be able to meet your shorter term requirements to repay that loan to the source. So it will make your business go bankrupt. Yes, balance sheet mismatch as well, you can say so. Okay, so this is the general principle which you need to adhere while you are arranging fund for your company. So now we are discussing in terms of you as a company owner and I as a company owner. Forget that you are a bank or a bank manager right now. When you are discussing financial management, you have to think yourself as in the shoes of a business. Clear? So purpose, non-current asset. What for non-current asset means? Non-current asset means which is not current. That means for longer period of time. So if you need to buy something, any non-current asset, then you have to arrange it from equity or long-term loan. Okay. Nature of borrower: normally startup, SME, mid corporate, large corporate need longer term loan. Current asset which is for 1 year. Long-term loan or short-term loan, both can be arranged. Okay. Medium-term loan for SMEs. Non-current asset, you can also arrange short-term loan for large corporates. This is large corporates can manage because they have other sources too, and they will square off their positions in going forward. So they can also afford having non-current asset from short-term sources. Clear? So stages of business: early stage, high uncertainty in business, equity or mainly angel fund. You arrange the fund. Okay, when it is moderate uncertainty is there, then venture capital or debt can be a source of fund. In a growth stage, debt, venture capital and private equity. In stable stage, it is low uncertainty, then you can create or you can issue debt instruments like bonds and debentures. Clear? So classification of financial sources, it could be external or internal. External could be the share capital, equity shares or preference shares. External means from outside. Okay. Debt or borrowed capital through debentures, loan from financial institutions. These two are part of external. Internal is mainly retained profit. Retained profit is nothing but the profit you make every year. Portion of that you pay as a dividend to the business owners, and a portion of that profit you keep every year as a reserve. So that is retained earnings. Clear? So sources of financial based on maturity of payment, long term, short term, medium term. Long term sources are share capital and equity shares, preference shares, retained earnings, debenture, bonds, loans from state financial corporations, loan from banks, venture capitals, assets securitization, international financing like euro issues, foreign currency loans, external commercial borrowing. Medium term, again preferential shares, debenture bonds, public deposit, foreign currency bonds, euro issues, etc. Short term, trade credit is the example of short term loan. Okay, means you have taken some raw material from your service provider or provider of the raw material in credit. In a later date, when you do the business, do the sales, you will pay back them their loan. So that is also a funding, that is also a source, right? Accrued expenses from deferred income, short-term loans like working capital loans, fixed asset, various receivables from the customers. Like what happens? Like nowadays, mobile phones are sold in a pre-order basis. Generally, these MI kind of people do. They will give you pre-order. The phone is not yet released. It is not in stores. First, you pay for the phone, and after you pay 15 days, 20 days, 30 days after that, when the phone goes live, pre-booking, right? So what is pre-booking? It is a loan from the customers. They will take the funding from the market and they will invest that in their inventory, creating the phone, whatever expenses they need to incur to manufacture these phones, they will get it advance. They will take that money in advance from the customer. So that is nothing but a loan. They are taking a loan from you. Clear? So nowadays there are hybrid type of funding people are arranging. Okay. Please explain to which one, Aman Shukla, please specify me. Clear? So up to this point of time, these are sources of various short-term, medium-term and long-term sources. Clear? Accrued, where is that? Accrued expenses and deferred income. So expenses that are accrued means you have not made the payment yet. Like you have made some expenses and yet you are yet to make the payment. Like electricity bill is an expense. This month's electricity bill has come to you rupees 2000. Deliberately you have deferred the payment. You have not made this payment. You will make this payment next year because you are running with crunch. Like if you are a salaried person, you have your some dues like home loan dues, etc. You deliberately bounce this month EMI because you have certain some other things which is not encouraged by me, but think that you have that expense you have accrued for next month. So that kind of expenses like electricity bill you are not paying this month. Next month the bill will be doubled. You will pay next month. That will be the accrued expense. Clear? Yes. And deferred income. Income that could be deferred. This month your salary has to come. It has not you are not receiving the salary, saying that next month I have so many expenses to make. Please pay me my 2 months salary one at a time. Clear? All this. Okay. So long-term sources of finance, share capital. This is the best way of doing business, raising share capital or debt. Owner's capital and equity capital. First thing, which is called share capital in other words. So public limited company may go for IPO like LIC is doing, other company do. So this is LIC is doing to sell the stakes of government, but normally new companies raise funds from public just to arrange their capital. So it's it is other words called arranging capital from market. It is owner's capital because you don't need to pay anything to your shareholder. They will buy a certain percentage of ownership in your company through initial public offering of yours. Then they can trade the shares to each other. You don't need to pay, but you got a initial capital. Whatever the IPO you sold, either in premium or discount, you will get all that money, and with that money you can enhance your business on their needs. They will take it. Now this is time for our MCQs. I believe that this has helped you to understand the basic concept of financing and financial needs of a company. Is it understood to all of you? Is it understood? Is it understood? Once PDF is uploaded in app, I will upload it after the class overs. You will go through it, you will cover it. Wherever you have doubts, we will cover it in next session. Clear? Okay. Equity shares have an ultimate life and voting rights and receivable dividends, have limited life with no voting rights, have unlimited life and voting rights but receives no dividends, have limited life, voting rights and receive dividends. What will be the answer? Yes, A is the answer. Have unlimited life, voting rights and receive dividends. Okay, clear, good. Second question on your screens. External sources of finance do not include debentures, retained earnings, overdraft, leasing. Yes. Many people are saying retained earnings. Very good. Very good. You people understood the concept very well. Great. Great. Internal sources. Which of the following sentence is correct? Debentures are basically instruments for raising long-term debt capital. Debentures receives dividend payments. The period of maturity normally 3 to 10 years. Debentures are either secured or unsecured. सौरभ डी बी कौन सा सही है? आंसर इज बी. डिवेंचर्स रिसीव्स डिविडेंड पेमेंट. ऐसा नहीं होता है, ठीक है. डिवेंचर्स आर डेट इंस्ट्रूमेंट्स. द कंपनी पे इंटरेस्ट ऑन इट, नॉट डिविडेंड. Which municipal corporation issued the first historical municipal bond in Asia to raise 100 crore? Delhi, Bombay, Ahmedabad, Kolkata. We just read it. It is Ahmedabad. Which of the following organization cannot issue government bonds? ICICI, RBI, GOI, any state government? Silly one, ICICI. Which of the following is true regarding commercial paper? As an unsecured money market instrument issued in the form of promissory note, the Reserve Bank of India introduced the commercial paper in 1986. Commercial papers are issued in denomination of 10 lakhs or multiples. Primary dealers are not allowed to issue commercial papers. Is true. A is true. It is issued in 1989 or 90s. It is 5 lakh and in multiples. Okay, primary dealers are allowed. Clear? So with this, we come to an end of this session. Thank you for being with us. Thank you for being with Knowledgist.